Good afternoon, students. My name is Buitumelo Lawate. I've created what is called the Management and Financial Accounting summary sessions, which we'll be covering in detail. Today, we'll be doing session 1. How I've set it up is on the left, you'll have your slides that we would have gone through in class. And on the right, I've tried to create a summary session on Excel. These summary spreadsheets that are uploaded on Excel will also be then taken to Lwazi if you want to make reference to some of these sheets. These sessions are designed as a summary, not to cover the work in detail, but to just have a recording which you can refer to if you need to look through what are the most important principles we should have covered in class. Okay, this session, the first one, deals with the income statement and the balance sheet, understanding those two statements. One thing you need to understand is that the income statement is the same thing as what we call the statement of comprehensive income. And the balance sheet is exactly the same thing as what we refer to as the statement of financial position. In the class sessions, we'll be looking through Shoprite's financial statements. And if you look at Shoprite's financial statements, they will deal with each of the different principles. They'll have the statement of comprehensive income, they'll have the statement of financial position, they'll have the statement of cash flow and the regarding notes. Okay, in class we will detail what's the importance of accounting and the different types of accounting. I think what's important with this slide specifically is that you need to know what the two fundamental characteristics of accounting are. Firstly, because we're producing financial statements for general users, we're either producing them for government users, we're either using them for SARS purposes or for just the general public to invest. These financial statements need to firstly be relevant, and secondly, they need to be faithfully representative. What does that mean? Relevant. Within the relevance fundamental characteristics, they are enhancing characteristic. What makes financial statements relevant? Firstly, they need to be timely. They need to be actually reported in time for us to make important decisions. They need to be comparable, either from company to company or from year on year. When you're looking at a company, I want to see within 2020, have the financial statements done well in comparison to 2019. That enables comparability. Secondly, your statements need to faithfully represent what they're saying they represent. Faithful representation means that these financial statements need to actually hold the test of whether they're actually verifiable. Okay? They need to be free from material errors and free from any subjectivity. So they need to actually, if you've got any subjective issue and you've had to come up with a valuation, how have you demonstrated that valuation? How have you verified that information? Either with supporting documentation, source documents, data, or anything that makes those financial statements verifiable. Okay, so we'll cover that in detail in class, but it's important to understand what a full statement of financial position or full statement of financial statements comprises. Okay, so we've got our income statement, we've got our balance sheet, we've got our cash flow statement, which we'll cover in session 3. We've got our statement of changes in equity and notes. Okay, your notes are there basically to describe any information that's represented in either your statement of income statement or balance sheet. So you'll notice when you look at, like, let's say a set of financial statements like Shoprite, within their balance sheet, they'll usually have description of where you can find the notes. So if accounts payable has like a note 8, you go down to the specific note and you get more information on what is actually made up of those accounts payable balances. Okay, for your purposes, you need to know very well the income statement, balance sheet, and the cash flow statement. We hardly ever test the statement of changes in equity, but it's important to know that a full set comprises also a statement of changes in equity. All your statement of changes in equity does is just describe what has changed in terms of the profits and what has changed in terms of the share capital when you're dealing with the owners of the business. Okay, if we look at the overview of the accounting process, there's steps 1, 2, 3, 4, 5. I will go through a detailed example in class of what actually happens within this accounting process. So let's say I go through my cell phone business. what are the source documents that you find within that source, within that cell phone business? What are the journal entries? What are the ledger accounts? Okay, because we are not training you to actually be accountants and to actually be filing all this information for a business, what is important from this overview of the accounting process is steps 4 and 5. We need you guys to be able to understand what has been represented in the trial balance. It's an accumulation of all the information that's happened within that year, and it's then represented in this trial balance format. The source documents and the journals have already been done for you, okay? So you don't need to then go and process any journal entries. You just need to understand a trial balance is then provided, and from that trial balance, how do I then go and compile my financial statements? We can ask you to compile either an income statement, or we can ask you to compile a balance sheet, okay? So you have to know these statements backwards. After you've been given this trial balance, you need to be able to read information from this trial balance to be able to create what is called the statement of comprehensive income or the statement of financial position. Okay, we'll go through the statement, the Shoprite financial statements in detail in class. But the first important thing that you need to know is the accounting equation. Okay, so within the accounting equation, what we then realize is on the balance sheet, we would have actually separated out, as you can see here on the right, we would have separated the assets, the liabilities, and the equity. Okay, these two balances, your liabilities and your equity, are basically what is called your sources of funding. They have funded the assets of the business. So let's say a business went to go acquire a property, plant and equipment and land. That land needed to be purchased from some form of funding or some form of facility. Either a liability, did we get a mortgage facility from a bank, or did the owners actually take out money up front to go and purchase this land or this property, plant and equipment? Either way, all assets will have been funded either from liabilities or from the equity of the business. And remember, your equity is not necessarily only the share capital of the business. Over time, because the business becomes profitable, it can have what is called retained earnings. What does your retained earnings represent? Your retained earnings represents the profits that have accumulated within this business. Okay? So if you've kept those profits and have retained the profits of the business, you can also use this profits of the previous years to purchase assets within that year. This is just a profit accumulation year on year. Okay, we will also cover in class the basic accounting principles. So we'll cover the matching, the going concern, consistency of presentation. But the most important principle within accounting that I wanted to cover in detail here to summarize is the concept known as the accrual basis of accounting, the accrual method. What this means is in our income statement and in our balance sheet, we want transactions to be recorded when they have happened, not necessarily when cash has moved. What does that even mean? Okay, so if I go into a business right now and I go and purchase a cell phone contract, okay, for Vodacom, and I only have to upfront take out either 300 Rand, whereas this phone that they've given me is worth maybe 11,000 Rand, let's say. Okay, just because I've only forked out the 300 Rand doesn't mean a transaction hasn't happened. So for Vodacom's purposes, if they have given me the cell phone, they've given me the risks and rewards, I can go and use the cell phone. For them, they can actually technically recognize that sale of that cell phone in their business. It doesn't matter when the 11,000 is paid over time. All that matters is I have granted them the risks and rewards and they have taken off the cell phone of my business. Okay, so if we've got the accrual basis of accounting, we don't look at when cash is received or paid for an item. We look at when did the actual transaction, when did the risks and rewards transfer. Okay, because the risks and rewards have transferred, we can recognize a sale. Okay, so what you'll actually see in your income statement, you'll have sales items or revenue items here in full, anything that you've sold. Okay, if you have sold an item but the person hasn't paid you in full, what you can then create is an asset called accounts receivable. Someone still owes you money, and it's an asset to you because once they give you that money, it creates benefits for your business. Okay, let's say you make any payments here for the year, you've technically incurred, you've used a telephone expense here, which you haven't paid for. Because you've used it, it needs to be recognized in your income statement, regardless of when you're going to be paying for it. Okay, if I've made use of a cell phone contract during that year and I've had a cell phone bill that I haven't paid for at the end of the year, it still needs to appear here in my income statement as an expense. However, I will then create in liabilities and accounts payable to show that I still owe that money. What the accrual basis of accounting also then recognizes is the fact that we actually also can have other accounts in your assets and other accounts here in your liabilities. If someone prepays you but hasn't actually taken the physical good yet and you haven't transferred the risks and rewards yet, you technically can't recognize the sale just because the cash has been received by you. So in that instance, you need to recognize a liability. You still owe the person the goods and services. This will then be called income received in advance. I've received income in advance, but I haven't yet been able to recognize it as a sale, as I still have the goods that I need to transfer to this person. Another asset that you can then recognize is called your prepaid expense. I've made payments in advance. It's an asset. That prepaid expense, I have actually prepaid, but I haven't utilized the expenses yet. So the expense won't appear here in my income statement, but I've got a benefit that I've already paid for that I can use in the future. Okay, so be aware of these accounts that are created as a result of the accrual basis of accounting. You've got accounts receivable and prepaid expenses and accounts payable and income received as a result of the fact that you are not recognizing items when cash is received or paid, but when actually the risks and rewards have transferred. Okay, our statement of comprehensive income, if we go through it in detail, I would have gone through it here, the layout. What we do have for our sales, our statement of comprehensive income, we've got our sales, our revenue, our cost of sales, our gross profit, any other income. We detail all our expenses here in detail. We've got profit before interest and tax, our interest expense, profit before tax, and then profit. This is the layout of your general income statement. It will show you what the results of the company have gotten over the period, which is usually over a year. You will recognize all the sales and revenue items and all the expenses which have actually happened in that year. If you've used a telephone expense, as I said, if you've actually passed on some goods that still people owe you on those goods, that sale will still be recognized within that year. Okay, that's your income statement. Your balance sheet, as I said at the bottom here, which comes up, you'll split it up between your assets, liabilities, and your equity. Be aware of these accounts that have come up as a result of the accrual basis of accounting, this income received. People usually get confused. What does it refer to? Prepaid. Prepaid, I have made a prepayment. Income received, I have received the income in advance. Okay, so that actually differentiates whether it's an asset or liability in your books. Okay, this basically details how you lay out your income statement and your balance sheet. We'll go through the owner's equity in detail, and we'll go through this example within the next session. Thank you very much.